Hi and welcome. Thank you everyone for tuning in to today's webinar on tax planning strategies for individuals. My name is Nancy and I'll be your moderator today. Before we dive into our presentation, I just have a few housekeeping notes to mention. First, everyone is muted to limit any disruptions. If you have questions, you're welcome to share them with us using that questions feature in your GoToWebinar control panel. And at the end of our webinar, we will go over those questions together, and if not, we will follow up with you afterwards. The webinar is being recorded and you'll receive a copy of it along with a slide deck tomorrow in your email. And finally, upon leaving, you'll be prompted to complete a very short survey. We'd love to know what you thought about our presentation and any other feedback that you have for us. And with us today, we have our resident tax expert, Suzanne Cox, and she is joined by certified financial planner, Chris Stennett. And Chris is a financial advisor within our investment advisory affiliate, Saltmarsh Financial Advisors. That's a mouthful right there. But Chris has 10 years of experience in being a wealth manager, and his areas of expertise include investment management, income planning, tax and estate planning, and risk management. So with that, I'm going to turn it right over to Chris to get us started.
Thank you, Nancy. Thanks everyone for joining us today. As Nancy mentioned, my name is Chris Stennett. I'm a certified financial planner professional here at Saltmarsh Financial Advisors. Now, one of the core principles that guides our firm is that we believe every investment decision is also a tax decision. I want to make it clear I am not a CPA, though I did stay at a Holiday Inn Express last night. That's effective, that marketing campaign, but let me get back to it. I'm not a CPA. Suzanne Cox leads our entire tax practice here at Saltmarsh. And together we serve clients in Florida and honestly throughout the globe with their professional and personal financial needs. So one of the biggest differentiators between our firm and other CPA firms is that our financial advisors can work internally with our CPAs to craft recommendations and discuss the full implications of those decisions across the spectrum of our clients' financial lives. This is the time of year when our internal collaboration becomes incredibly invaluable to our clients. So we're able to coordinate and execute on various strategies that we'll be discussing today, and I want to show you some of them. So first, we'll be covering investment account maintenance. Then we have health savings account contributions, retirement account contributions, required minimum distributions, qualified charitable distributions, investment loss harvesting, investment gains harvesting, and Roth IRA conversions. We've also allotted some time at the end just for some audience questions. I believe there's a chat box at the bottom of the webinar screen where you can submit your questions, and we'll hold on till the end of the presentation. Now, our goal today is to introduce you to these ideas, not necessarily cover every aspect of them. And our lawyers want to make sure we say that this session isn't designed to give specific investment or tax advice. To find out whether or not you in particular can benefit from any of these strategies, we're going to have our contact information shown at one of the last slides. Make sure to write it down and give us a call or shoot us an email. We'd love to talk. Suzanne, anything else you want to add?
I don't think so. Let's dive in.
So we've laid today's presentation out in order of complexity, starting with our easiest discussions and progressing to more complex strategies. One thing that everyone on this call should do every year is review their personal financial accounts and make sure these 5 actions are taken. Number 1, review beneficiaries across all of your accounts. For a variety of reasons, it's important to keep your beneficiaries up to date. Now, initially, those account beneficiaries are set by you, the account holder, though bank accounts might not be. But as changes happen during your life, it's important that you make sure you review these and update them as necessary. The second is reviewing that you have adequate cash across all of your accounts, specifically for the next 12 months worth of need. Plan ahead for future withdrawals. If you're managing your own investments, be aware that they are not static, they are dynamic, and they will fluctuate over the year. The last thing you want to have happen is for you to watch your account dwindle in balance the day before you plan on taking the money out, whether it was for required minimum distributions or simply because you wanted to make use of the money. It's important that you are aware that risk is a factor in investment management, and keeping funds in cash that are going to be needed soon is really the best strategy. Number 3, it is a good habit to record all of your personal financial accounts online login credentials into somewhere and let your executor know that this information exists. Just think about how difficult it would be if something happened to you and someone was, your executor or your loved one was trying to unwind your financial affairs. We also see that a lot of accounts have what we would call two-factor authentication. So having record of how you access these accounts, what websites you use, and even potentially including your executor's phone number as part of the two-factor authentication can go a long way to making sure that your financial affairs are continue to be handled even if you're not here. Now, one thing we've done at Saltmarsh is we've created a wonderful worksheet called our Asset Inventory Worksheet. If you go to our website, saltmarshfa, as in financial advisor.com, you'll see our Asset Inventory Worksheet at the bottom of the page. You can download it, print a copy for yourself, and use it to be the initial roadmap so that you can capture all of this information.
If you take nothing else from this slide, I'm sure everybody's familiar with that package you get annually from your investment advisor that you most likely put in the circular file. Pay attention to that. Make sure you fill that out because that's information that Chris needs. And if you're not meeting with your advisors at least annually, hopefully you're meeting with more. But if you're not, make sure to have your annual meeting sometime very soon so you can take advantage of some of these opportunities. So just take that away.
Yeah, very soon is an understatement. We are very busy right now, so we will certainly make time for you, but call us sooner rather than later. Now, the fourth thing is making sure that your required minimum distributions have been taken across all of your retirement accounts. We're going to touch on that a little bit later. And then finally, and this is really just good practice, is just review all of your taxable accounts. You've got gains, hopefully no losses, but we'll address that as well. You might have dividend income or interest income. Just write it down, and in February, when you get your 1099 composite statement, make sure the numbers match up. So let's talk about health savings accounts. We call them HSAs for short. An HSA is a savings and investment plan. It's designed to help cover future medical expenses, and it has some really good tax benefits. These plans, they're a bit nuanced, and you're going to hear that a couple of times today. And today's strategy, again, it's not designed to cover every aspect of this particular account type. Rather, we want to introduce those, or remind those rather, that currently have an HSA to make their annual contribution. We also want to introduce people who've never heard of an HSA to this fantastic and often underutilized investment account. And there are some fantastic tax benefits. The first would be tax deductible contributions. So when you put money into this account, it lowers your taxable income. If I made $50,000 this year and I contributed $1,000 to an HSA, only $49,000 of my income is subject to federal income taxes. Now that $1,000 that gets placed into the HSA, it can be invested and it can grow. At the end of the year, what if my $1,000 account is now $1,500? Well, that $500 in growth is not taxable as long as it remains in the account. We call that tax deferred growth. And finally, tax-free withdrawals. So that $500 I just mentioned, it might not ever be taxable, provided that when I take the money out, it's used to pay for qualifying healthcare costs. And that definition of qualifying healthcare costs, it's always expanded. Suzanne, what are some of the interesting uses you've seen HSAs used for?
Yeah, so this is an area I will tell you I wish I would have known more about earlier in my life. For example, when I got LASIK, I didn't know that LASIK could be covered by it. I have heinously terrible eyes prior to LASIK, and I didn't know eyeglasses and eye exams were covered either. So maybe you guys are ahead of me and knew that all of that was available to you. I did not. There's other things. You can get acupuncture, another thing I wish I would have known, I would say earlier, because I'm a fan. PT, physical therapy, that isn't covered a lot under insurance, but it is an allowable expense. And then the most recent thing I found out is blue light glasses. So if you guys can see the blue light glasses here, oh wait, there we go. They are covered. And so again, imagine my dismay. I just got these a couple months ago. I didn't know I could have used that. So blue light blocking glasses are covered under HSA. So there's a bunch of other fun stuff. If you need any more information on what's covered, I'm an expert right now.
Yeah, now we have, obviously with coronavirus being such an impact, we've seen the changes to that where now you can get an in-home coronavirus test using your HSA. So this account type, it's going to change over time as far as what constitutes a qualifying medical expense, but almost everyone on this call could benefit from it. Now, you typically have to be covered by what we call a high deductible healthcare plan in order to make contributions. And you probably want to have an expectation of some sort of future medical expenses. Otherwise, you're not going to see the same types of benefits with those tax-free withdrawals. But technically, you could use this money towards your retirement. Again, it might not be a tax-free withdrawal unless the money was used for healthcare expenses, but that doesn't mean that there's not a benefit in having tax-deferred growth. Now, one of the things unique about us at Saltmarsh is we actually have an entire practice dedicated to consulting, designing, and enrolling clients in HSAs, as well as other benefit plans. So we're going to leave Judy Fryer's contact information at the end of this presentation in case you'd like to learn more. Retirement account contributions. So as the end of the year approaches, it's really important to make sure you're on track for funding your retirement. Now is a good time to check across your retirement plans and see how much you've contributed and see if any changes need to be made. So there are two primary types of retirement plans that really are part of most of our lives. The first would be an employer-sponsored plan, and the second, an individual retirement account. Now, the most common types of employer-sponsored plans are 401ks, 403bs, and 457bs. Now, these plans are funded incrementally through each paycheck and bonus you receive. You're limited as to how much you can contribute each year, and typically you can only contribute during the calendar year, though some plans do allow for lump sum contributions. Now's a good time to check your contribution rate, meaning the percent per paycheck that you're contributing, and make adjustments for the remainder of the year. It's also a good time to plan ahead for next year, as you're likely going to be informed of possible changes in pay, as you worked hard this year. The second, individual retirement arrangements, or IRAs, they're not associated with any specific employer, and they're funded through direct transfers from your bank. There are limits as to how much can be placed in these accounts as well as limits based on income, age, and availability for household members to participate in employer-sponsored plans. Now, these types of account contributions are typically due by the 2021 tax filing deadline, which, as I know right now, is still April 15th, although that's probably subject to change. But for some individuals, it may make sense for them to make the contribution before 12/31. I've given a lot of presentations on the differences between traditional contributions, both deductible and non-deductible, as well as Roth contributions. So for the sake of today's presentation, I'm going to assume everyone on this webinar understands the difference, but if you're not aware, just ask us at the end of today's presentation, and I'll cover it as time allows.
Sorry, I was muting for the potential echo. Forgot I was on mute. Chris, I get a question a lot, especially around this time, is it better to put my money into my individual account, or is it better to take advantage of a company sponsored plan, such as a 401k? So, people are wondering, do I put the money in Roth or an IRA, or do I use my 401k?
I've heard that too, and I don't know who started that, and I'm not happy with them. So our opinion on it is pretty clear. If your company is going to give you money, start there. You know, if you're getting a match, if you're contributing 10% and your company is going to match 3%, well, that's an additional 3% of money you're going to receive that didn't have to come out of your own pocket. Regardless of whether or not you've worked for the company for long enough to be vested, no one knows what your future is going to be. So you might as well take advantage of that, because most plan options are affordable enough or have enough investment choices within them to make that kind of plan worthwhile. So yeah, in our estimation, absolutely, at least start by taking full advantage of your company match. And then if you want to get a little bit more, intricate with your funding, then you can start looking at pre-tax or Roth IRAs.
So if you max out your 401k, then you could, go to an alternative individual type of plan.
Yeah, if you max out your Roth, if you max out the employer match and you say, all right, well, I've got more money to contribute, well, then you could put more money into your employer plan or more money into an IRA account.
Gotcha.
And from there, it's really up to you. But I mean, if we're talking about making $30,000 a year in contributions, you're probably going to want to use both plans because you can't put that much aside in just a single IRA. Now, required minimum distributions. These are really applicable to retirement accounts, and we call them RMDs for short. You'll probably hear me use that term a few times today. And what they are is mandatory amounts that a retirement account owner must withdraw each year, starting in the year he or she turns 72. So these withdrawals typically need to be taken by the end of the calendar year, though in some cases the withdrawal can be delayed. Generally, an RMD is calculated for each retirement account by dividing the previous year-end balance by the life expectancy of the account owner using IRS tables. To give you an estimate, your first RMD is going to be approximately 3 to 4% of the total account balance. Because everyone's situation is different, I'd encourage you to consult an expert before you decide to skip any minimum withdrawals.
So do you have an example or something? It sounds like these are kind of complex rules. Do you have an example you could give us?
Yeah, they are complex. So imagine you're a 72-year-old active employee. You have a 401k and an IRA. If you're still working for the employer that sponsors the 401k plan, you're not required to take an RMD from that account, but you definitely have to take it from your IRA this year. But if you're a 5% or greater owner of the business sponsoring the 401k plan, then you have to take an RMD in all of those accounts, regardless of whether or not you're retired. Now, the RMD rules apply to all employer-sponsored retirement plans and most individual retirement accounts. IRA owners with multiple IRAs, they can aggregate their withdrawals. So while it may be calculated as a separate account balance, you could take it from a single account. Same is true for 403B owners with multiple 403Bs. However, required minimum distributions from other type of plans like 401ks and 457s must be taken separately. What's even more strange, RMD rules apply to Roth 401ks. They don't apply to Roth IRAs, at least while the account owner is still alive. And these rules matter. So failing to take the proper withdrawal from each account could result in a 50% penalty. It's a pretty steep price to pay.
Yeah, that is a steep price. And as we mentioned earlier, they seem like the rules are a bit complex here. So if you're at the point in life where you're taking required minimum distributions, it sounds like something you should get with your advisor on. And jumping ahead to our next slide, this is something I learned in the very recent future, that you can do this. So you can take your required minimum distribution and transfer it straight to a qualified charity. So Chris, tell us a little bit about that.
Yeah, they're called qualified charitable distributions, QCDs for short. We love acronyms. So a QCD is a distribution made from your IRA, other than a SEP or a simple IRA, to a qualified charitable organization. Now, typically QCDs go hand in hand with required minimum distributions, but that changed slightly last year because you can be at least 70 and a half when you do a QCD. you have to be 72 to do an RMD. So there's this 1.5 year gap that you could execute one strategy without being subject to the other. Now, in order for this to work, as I mentioned, the 70.5, you have to be 70.5 at the time the distribution is made, not in the year, at the time. You also have to have some type of formal communication from that organization acknowledging your gift. QCDs, they have to be done through a direct transfer, meaning you cannot receive the money directly, and this might come as no surprise, but you also can't have any beneficial interest in the charitable organization to qualify as a QCD. So the benefit of the QCD is that you can take up to $100,000 out of your IRA account and give it to charity without owing taxes on that amount. Though the $100,000 is the maximum, you don't have to have a large IRA balance to benefit from doing it. I've got an 80-year-old client. She has a pretty small IRA balance, and she used to give to her church every Sunday at the offering plate. She was living off of her Social Security checks as well as her IRA minimum withdrawals. That meant that some of the money that she was actually giving to the church, she originally paid taxes on, hit her bank account. From there, she gave it. So I talked to her about QCDs, and together we created a plan. Now we're sending money to her church every year, completely tax-free. This did 3 things for her. First, it satisfied her initial desire to give. That's really the most important reason to her. Second, well, it reduced her taxable income by the amount that she sent to her church. And third, pretty nice benefit, it actually put her in a lower tax bracket than she was previously in. So all in all, it's a pretty good win.
Yeah, for sure. We typically see QCDs at the beginning of the year, although that's not, required. So if you haven't made one yet this year, you might still be eligible. And even if you're not eligible this year, you may want to start thinking about next year. So if this hasn't been on your radar so far, make sure to ask about this so you can take advantage.
Yeah, and we're hearing more and more about it as we're talking about it, sort of educating others, but we're not the only ones out there that love this strategy. But again, you want to be charitably inclined first. Avoiding the taxes isn't the win. So next,
double win.
Yep. Next, we have a strategy known as loss harvesting. And this is one that maybe many of you on the call have heard about before. So the idea of this strategy is to target specific investments inside of a taxable account that have unrealized losses, often of a great magnitude. And we want to sell those losing positions to create a realized loss. Now we're targeting investments that have been held for longer than 1 year, because we want this to apply to your long-term capital taxes. So the purpose of this strategy is either to partially or wholly offset those long-term capital gains and or create a future carry forward long-term capital loss that you can use on subsequent tax years. Now that's because long-term capital losses offset long-term capital gains in a given tax year. And in a year like 2021, there's likely to be quite a few taxable long-term capital gains in your investment portfolio. One thing to keep in mind, though, when you're going to execute this strategy is something we call a wash sale rule. That means that you can't sell the investment and count the loss if you end up repurchasing the same or similar investment within 31 days. And one very interesting loophole that exists today involves losses on cryptocurrencies. So currently, the wash sale rules do not apply to cryptocurrency transactions.
Yeah, cryptocurrency is still such like a new investment strategy that although nothing formal has been regulated or passed to get rid of that loophole, I foresee, my crystal ball tells me that that may be upcoming, and regulators are still trying to get their arms around how to manage cryptocurrency and what's what are we doing there. So so I think that's down the road a little bit.
Yeah, might be sooner than we think.
Yeah.
So to kind of help bring this idea into a little bit more clarity, I want to go through this example. So since the great financial crisis of 08, we've seen stock markets continue to reach new highs. While growth is generally a good thing, the massive growth in stock values has also presented some investors with challenges. So many investors, they just find it hard to sell when their money is doing really well. But they have to balance the potential tax implications of selling versus the risk of holding a concentrated position. So let's go back 3 years. Imagine it's October 2018, and you've got $100,000 in your taxable portfolio. At this time, you want to make a purchase of 2 company stocks, Tesla and Marathon Oil. Each purchase is going to be $1,000. Now, initially,
as you can see, guys, we're very diverse investors. You know, Tesla and oil. So, you know.
Yep. We want to run the spectrum. You know, playing both sides of this. Who knows?
Exactly.
Now, that initial purchase, it's only at the time representative of 1% of your total portfolio. Now, for the sake of this example, let's assume that the rest of the money that you have just doesn't grow over the next 3.5 years. I don't know, maybe it was in cash the whole time. Well, fast forward to today. Your initial $1,000 Tesla stock, roughly about $20,000 today. That means it's 20% of your total portfolio. So you look at this and you say, wow, that's a lot. I want to get rid of some of this. But like I said, you're probably a little bit worried about the tax implications of selling. So to limit the impact of gains, you could do what we call tax loss harvesting. We're going to sell a position that has an unrealized loss. Well, fortunately for you, you bought Marathon Oil, and they're down 50%. So you can take a $500 capital loss by selling the entire position and apply that to a proportional share of transactional sell in Tesla. That can start to bring your portfolio back into alignment. Now, one thing I want to make really clear, this strategy does give investors that added flexibility on managing taxes, but we still feel the most important driver of whether or not to buy or sell any security is how that investment impacts the portfolio's risk profile. Manage the risk first, then handle the taxes.
And if you're anything like me, you leave that up to Chris.
With a consultation from our CPAs, of course.
Oh, I meant from a buying and selling and risk perspective of the portfolio side is what I meant. You know, I don't get into the market personally. Leave that up to the experts.
Again, I think that's one of the biggest benefits is we get to specialize in our areas without having to spread ourselves too thin. I mean, we're constantly seeing tax laws change. We're seeing investment laws change.
Exactly. I can only handle one side of the coin, you know.
Yep. Jack of all trades, master, something like that.
Right, exactly.
So along the same lines as investment loss harvesting, we have a lesser known strategy called gains harvesting. So investment gains harvesting is used to accelerate income in a current tax year. And what we're trying to do is sell a position that has grown in value. Again, we want to target positions that have been held for longer than 1 year. What's nice about this rule is there's no wash sale. So you could theoretically have a position, sell it at a gain, and immediately rebuy that position without negating the gain. Why? Well, because the IRS can still collect taxes on gains.
So you might be asking yourself, why would anybody do this, right? So it all boils down to taxes, of course, as does a lot of things. So at certain lower income levels, the tax rate for long-term capital gains is 0%. So in a series of transactions, an investor can realize a gain by selling a position, owe 0% tax on that gain, then repurchase the same investment to increase their cost basis. So even if the investor, though, doesn't qualify, because not everybody may qualify for that 0% long-term gain rate, the strategy may still be beneficial if there is a belief that perhaps that future long-term capital gain rate will be higher than today's rate. And so if investor expects their income to increase Or, perhaps tax laws, as you know, are changing pretty rapidly. It may, maybe something you want to look into. Even a change in your marital status can affect your rates. So it's again, like we said, it boils down to, does it make sense from a tax perspective?
Yeah. Yeah, it doesn't matter if you're a low income individual or a high income, it's something worth taking a look at. But to make it a little bit clearer, imagine you bought an S&P 500
Wait a
index.
minute, do you have an example, Chris?
You know it.
Chris is our example guy.
It's the way I speak, I guess.
We love it, we love it.
Imagine you had originally purchased an S&P 500 index fund for $1,000 in your taxable account. The basis, meaning the amount that is not taxable, would be $1,000. What if now, today in 2021, the value of that account is $10,000? Well, if you sold the entire fund, you'd be liable for taxes on the $9,000 in gains. But if this investor is married and their combined taxable income is less than $70,000, they're going to qualify for that 0% long-term gain rate. So they could sell all $10,000 of the fund, pay 0% in taxes on the $9,000 gain, and immediately repurchase that S&P fund for $10,000. Now they've got that new cost basis so that any future transactions that they decide to do, like selling this fund again, potentially lessen the tax impact. So I'm a big fan of this one, although it's one that not a lot of people are using, because again, it means you have to pay taxes along the way in some cases. So
it looks like we're doing good on time, Chris, so we should be able to cover the Roth IRA conversions.
Good, because this is one that I know a lot of people want to learn about. So Roth IRA conversions have become incredibly popular in recent years, in part due to changes in tax laws. But you also have a lot of advisors who are trying to bring this to the attention of their clients. So this strategy, what it does is it involves taking money in a traditional IRA and moving it to a Roth IRA. Because funds in a traditional IRA are typically pre-tax dollars that have never seen the tax light of day, and Roth accounts are after-tax accounts, strategy creates a taxable event. So it's really divided, when you think about a Roth conversion, into two specific types. There is the standard Roth conversion and what's known as a backdoor Roth conversion. So first, we want to hit on the standard Roth conversion. For a standard Roth conversion, an investor can choose to convert some or all of their pre-tax IRA balances to a Roth IRA. Because, as I mentioned, this is taxable, investors should be mindful as to how much they convert, so they don't push themselves into a higher tax bracket. Now, the reason someone would typically use this strategy is because they have a belief that they could prepay taxes at today's rate with the expectation that their future tax bracket will be higher. And that's a common assumption, I think, that people have, that their tax rates today are going to be higher than when they retire. And I think that's kind of reasonable, but this assumption leaves out a few key details and why we're really starting to talk about it more with our clients. So first, I mentioned that required minimum distributions will be due on your IRA account when you turn 72. And I also mentioned that it will be about 4%. What if you and your spouse both worked and you both did a great job of saving for retirement? Well, it's possible that each of your IRA balances could be in excess of $1 million at the time of your first RMD. Because your combined RMD would be in excess of $80,000 and will likely continue to grow over time, that's a large taxable income source to receive. This plus Social Security plus any other taxable income could actually push you into a higher tax bracket in the future than you were in when you were in your first few years of retirement. The second detail that this assumption leaves out is that one spouse typically predeceases the other. Right now, it's at about a rate of 5 years. And when your spouse passes away, you inherit their IRA and their RMD responsibility. But now, you're not able to file taxes married jointly. You're going to have to file as a single tax filer. That's much less favorable. A married couple today making $165,000 in taxable income falls in the 22% bracket. A single filer with the same income is in the 32% tax bracket. Now, if there's an age difference between spouses, that tax filing status could last even longer. But if that's not enough to convince you, there is a third reason to consider this, and that's because of the new 10-year rule. Upon the death of the second spouse, all the remaining assets are inherited by a non-spouse beneficiary. For retirement accounts, those beneficiaries are required to withdraw all of the money from the account and pay the respective taxes within 10 years of inheriting those assets. Now, most people name their children as their beneficiaries. What if they're doing really well financially? After all, you raised them, right? Well, they could be in a higher tax bracket today than their parents were at any point throughout their retirement lives. Now they're forced to take out even more taxable income at these higher rates, leaving less of an inheritance. So, how do we use a Roth conversion to fix that? Well, the idea of a Roth conversion, again, would be to prepay taxes while the investor's in periods of lower income. So we would typically target that period of time between retirement, but before RMDs begin. From here, we would systematically convert a portion of their pre-tax IRA accounts to Roth year after year, while being mindful of what that extra income does to their total taxable income. So our goal is to fill up an investor's current tax bracket without pushing them into a higher one. So if a married couple has $100,000 in taxable income, well, we could still convert up to $72,000, have them remain in the 22% bracket. However, if this couple has a very large IRA balance, it might actually benefit them to convert even more, because the next bracket is really the 24% bracket, a change of 2%. And that would give us an added $200,000, almost $200,000 per year that we could convert.
Hey, Chris, can you expand on the 10-year rule, and how long has that been in effect?
It's pretty new. 2020 is when it started. So this is technically year 2. And it's been a bit of a nightmare. Yeah, so the 10-year rule doesn't apply to spouses. Spouses get to treat, if they inherit, their deceased spouse's money, they get to treat the money as if it's their own. It's really upon non-spouse beneficiaries, although I bet you can guess that there's some nuance even to that rule. But it's something that over the last 2 years has become much more apparent to the advisor community, that when we deal with these large pre-tax balances and we're thinking about estate planning, leaving money for the next generation, we want to maximize individuals' net wealth, the amount of money they physically get to keep. So thinking ahead and knowing what your client's goals are, this is one of them. It's something that we need to be bringing to their attention and let them decide what they think is best. So let's take a look at this chart and help bring a little bit more context to this idea. So here we have an illustration, a graphical illustration of a $50,000 conversion. So here in yellow is the annual $50,000 conversion between age 60 and age 62. The traditional IRA account balance is represented in blue, and the Roth IRA balance is reflected in green. Now, one thing I will note is that this chart, we haven't been able to update it. The rules for RMD, as I mentioned earlier, are age 72. If you notice, the orange line starts to shoot up around age 70, but the impact of this is really still the same. The more money that you can convert, the bigger the values of the account can grow, and they're growing tax-free. So imagine an individual who passed away at age, pick an age, 90. We've got an account balance, total account balance, of $4.5 million. It's called about $1 million that's in pre-tax money, and $3.5 million that's held inside of a Roth account. So the 10-year rule applies to Roth, and it applies to traditional IRAs. But if you're taking millions of dollars out of a tax-free account, you're not really worried about the tax consequences of that. If you're taking $1 million out of a pre-tax account, like myself, an only child, that could be a pretty big damper to our family's finances, at least for those next 10 years. And there's really no way around that rule. And here it is, the pièce de résistance of complexity. If you thought you needed to consult a financial professional before, you absolutely need to consult one before trying this strategy. I'm talking about a backdoor Roth conversion. And I'll briefly hit on what this is. And I know if we have questions, probably the safest thing to do is just follow up through emails, because this is one that I know was requested by a couple of individuals in the audience. So a backdoor Roth IRA conversion is essentially moving money from a pre-tax account to a Roth account, but it's a really roundabout way of doing it. So first, not everyone can directly contribute to a Roth IRA. If you make too much money, you're not eligible to contribute. Now that also means that you're probably not eligible to take a tax deduction on traditional IRA contributions. But one thing you can do, you can take a non-deductible contribution to a traditional IRA. So your contribution is not pre-tax money, it's after tax. Well, a backdoor Roth would be accomplished by first making a non-deductible IRA contribution into a traditional IRA, and before you invest that money, immediately transfer it to an existing or new Roth IRA, and then invest the money there. Because that money is after tax and there's no earnings tied to it yet, it is a tax-free rollover, so to speak. Sounds pretty simple, huh? Well, unfortunately, most people don't just have a single traditional IRA, or if they do, that IRA contains both pre-tax and after-tax money. Now that might happen if you rolled over a 401k plan into this IRA, or if you invested non-deductible contributions from past years and they've grown, or simply you contributed through a deductible contribution when you made less money. So to solve this problem, you have two options. Option one, continue doing a backdoor Roth conversion. Transfer some or all of the money directly into the Roth IRA. Or option two, leverage an existing 401k plan and avoid the pro rata rules. And so briefly, option one. Imagine in this example, you had $200,000 in a traditional IRA, and today you decided to make a $5,500 non-deductible after-tax contribution. Now you've decided you want to convert $5,500 to Roth, and in your mind, you're thinking, hey, that's the after-tax money. But because of a rule known as the pro rata rule, investors cannot segregate after-tax money from pre-tax money. The distributions and conversions will be treated as a proportional withdrawal of both. So in this case, $5,500 represents just over 2.5% of the total account balance, meaning that if you moved $5,500 to a Roth IRA, you'd be paying taxes on 97% of that. That's quite a shock if you were expecting this to be tax-free. Now, if the traditional IRA is mostly pre-tax money, you're probably not going to want to use this option. If the traditional IRA is mostly after-tax money, I'd consider using this. Now, option two, it's a little bit more complex, but you have to have a 401k for this to work. So if you don't have an active 401k plan, it doesn't even apply. But it's basically a glitch in the IRS matrix. It allows you to bypass the pro rata rule and simply move that $200,000 account into a 401k. That $200,000 is held separately from the $5,500, held in the pre-tax IRA. And from that point, you could convert the $5,500 to Roth. The one thing you do not want to do in this example is move the money back from the 401k into that IRA in the same tax year. So, Suzanne, are we fun at parties or what?
We are. Let me tell you, for real. I was just about to tell you, Chris, you're on a roll, and I was like, oh, we're working on the last minute of our time here, but I knew it was a good, interesting topic. So thanks, Nancy, for breaking in. I think Chris could go on for days.
Yep.
It's all good.
So last thing I want to say, if I haven't made it clear enough, don't do this on your own. This is our job. We take it very seriously. And we've got people in-house on both the financial planning and the tax side to help you sort through these decisions and figure out which, if any, strategy is appropriate for you. So I want to thank you all for joining us today. Thank you for your time, and I'm certainly looking forward to speaking with some of you soon.
Yes, thank you everyone, and thank you Chris and Suzanne. Chris, if you could go to that next slide. And I just want to let everyone know that this was part 3 in our webinar series about year-end tax planning. So if you missed our previous ones, you can go to our blog and you can request access to see those recordings. And we're also going to be doing a 4th webinar on the new tax law changes, and we hope you guys can join us for that one. But registration is pending legislation, so we will notify everyone about that registration being open whenever we put that on our calendars ourselves. But feel free to contact a member of our team. Like they said, if you have any questions, and also following this webinar, you'll be prompted to complete a short survey. We hope you guys can give us some feedback so we can improve our webinars in the future. And with that, I'm gonna let you guys all go, but thank you again for joining us today.
Thanks, guys.
Bye.